After studying this module, we shall be able to know what are the receivables, evaluate what are the costs and benefits involved in managing receivables, analyze the important dimensions of effective management of receivables, identify the approaches to credit policies, namely credit standard and credit analysis, understand the credit terms of receivables management, namely cash discount period, and credit period. Know the types of collection policies.
When goods and services are sold under an agreement permitting the customer to pay for them at a later stage, the amount due from the customer is recorded as accounts receivables. So, receivables are assets, accounts representing amounts owed to the firm as a result of the credit sale of goods and services in the ordinary course of business. The value of these claims is carried on to the asset side of the balance sheet under titles such as accounts receivables, trade receivables, or customer receivables. The term can be defined as debt owed to the firm by the customers arising from sale of goods or services in ordinary course of business. According to Robert N. Anthony, account receivables are amounts owed to the business enterprise, usually by its customers. Sometimes it is broken down into trade account receivables. The former refers to amounts owed by the customers and the latter refers to amounts owed by the employees and others. Generally, when a concern does not receive cash payment in respect of the ordinary sale of its products or services immediately in order to allow them a reasonable time period to pay for the goods they have received, the firm is said to have granted trade credit. Trade credit thus gives rise to certain receivables or book debts expected to be collected by the firm in the near future. In other words, sale of goods on credit converts finished goods of a selling firm into receivables or book debts. On their maturity, these receivables are realized and cash is generated. Receivables, also termed as trade credit or debtors, are components of current assets. When a firm sells its products in credit, account receivables are created. Account receivables are the money receivables in some future date for the credit sale of goods and services at present. If a company has receivables, this means it has made a sale but has yet to collect the money from the purchaser. Most companies operate by allowing some portion of their sales to be made on credit. These types of sales are usually made to frequent or special customers who are invoiced periodically and allows them to avoid the hassle of physically making payments as each transaction occurs. These days, most business transactions are on credit. Most companies, when they face competition, use credit sales as an important tool for sales promotion. As a sales promotion tool, credit sale enhances firm sales revenue and ultimately pushes up its profitability. But after the credit sale has been made, the actual collection of cash may be delayed for months. As these late payments stretch out over time, they may cause substantial drop in companies' profit margins. Since the extension of credit involves both cost and benefits, the firm's managers must be able to measure them to determine the ultimate effect of credit sales. In this perspective, we define the receivable management as the aspect of a firm's current assets management which is concerned with determining optimum credit policy associated to a firm, such that the benefit from extension of credit is greater than the cost of maintaining investment in accounts receivables. The basic purpose of firm's receivable management is to determine effective credit policy that increases the efficiency of firm's credit and collection department and contributes to the maximization of value of the firm. The specific purposes of receivable management are as follows. Number 1, to evaluate the creditworthiness of customers before granting or extending the credit. Number 2, to minimize the cost of investment in receivables. Number 3, to minimize the possible bad debt losses. Number 4, to formulate the credit terms in such a way that results into maximization of sales revenue and still maintaining minimum investment in receivables. 5, to minimize the cost of running credit and collection department. 6, to maintain trade-off between costs and benefits associated to credit policy.
Receivables are one of the most important components of current assets. Receivables generally refer to the debt which the customers owe to the firm from sale of goods or services in the ordinary course of business. When a sale of a good or service takes place in the ordinary course of business and customers do not pay in cash, the firms allow a reasonable period of time for which the credit is extended. This is represented as accounts receivable in the balance sheet of the firm. In today's competitive times, offering credit sales is integral to a majority of businesses. At one end, it helps the business to boost its top line and bottom line. At the other end, it generates risk and cost for the firm. Let us now understand the various costs and benefits associated with managing receivables. Costs. Collection cost. These are costs incurred in collecting receivables from customers to whom credit sales are made. Capital cost. While extending credit, the firms incur additional costs to meet their obligations when the funds could have been deployed elsewhere. This happens due to the presence of time gap between sales and receiving of payment. Delinquency costs. These refer to the costs which are incurred due to failure of the customers to pay within the credit period. Thus, due to failure to receive payment in a timely manner, firms incur additional costs to recover dues. Examples include reminders, legal notices, etc. Default costs. These represent bad debts as customers do not pay their dues. Here, the firms incur costs as customers fail to make payment even after repeated reminders. The associated benefits are increase in sales. Firms offer the option of both cash and credit sales to customers in order to boost its sales. Profit generation. Credit sales also help in increasing in bottom line, that is, profits, along with increase in the top line, that is, sales. Further, it also aids in dealing with competition effectively. Growth expectations. With expectations of increase in sales and profits, it provides for further growth and expansion of the firm. Customer retention. This also helps in ensuring customer loyalty towards the firm. It is useful for retaining existing customers as well as attracting new customers. There are various dimensions of receivables management, that is, credit policies, credit terms, and collection policies. We shall discuss them in detail. To begin with, let us start with the first dimension, that is, credit policies. The main decision while extending credit includes determining whether the customer should be given credit or not. In case credit is extended, for how much period should the credit be allowed? Credit policies include credit standards and credit analysis. Credit standards represent the basic conditions for offering credit to customers. These could include credit standing of the customers, credit references, etc. The credit standards can be tight credit standards and liberal credit standards. In case of tight credit standards, less credit will be extended. In case of liberal credit standards, more credit can be extended easily. Tight credit standards are characterized by lesser sales, lower amount of receivables, more creditworthy customers, smaller collection period, less collection efforts, bad debts, and costs. As against this, liberal credit standard policy is characterized by higher sales, higher amount of receivables, less creditworthy customers, longer collection period, more collection efforts, bad debts, and costs. Credit analysis refers to obtaining the information about credit and then analyzing it. Credit analysis helps in knowing the creditworthiness of the customers. It includes two main steps: obtaining credit information and then analyzing the information so obtained. Credit information can be obtained through internal sources like forms and documents submitted by customers, historical payment pattern, etc. External sources like credit rating, bank references, financial statements, etc. Analyzing of the credit information can be through quantitative methods like preparation of aging schedules, undertaking ratio analysis, trend analysis, etc. Qualitative methods like subjective interpretation of various financial statements, references from suppliers, other creditors, banks, financial institutions, etc.
Credit analysis is the method by which one calculates the creditworthiness of a business or organization. In other words, it is the evaluation of the ability of a company to honor its financial commitments or obligations. The audited financial statements of a large company might be analyzed when it issues or has issued bonds, or a bank may analyze the financial statements of a small business before making or renewing a commercial loan. The term refers to either case, whether the business is large or small. The objective of credit analysis is to look at both the borrower and the lending facility being proposed and to assign a risk rating. The risk rating is derived by estimating the probability of default by the borrower at a given confidence level over the life of the facility and by estimating the amount of loss that the lender would suffer in the event of a default. Credit analysis involves a wide variety of financial analysis techniques, including ratio analysis and trend analysis, as well as the creation of projections and a detailed analysis of cash flows. Credit analysis also includes an examination of collateral and other sources of repayment, as well as credit history and management ability. Analysts attempt to predict the probability that a borrower will default on its debts and also the severity of losses in the event of default. Credit spreads the difference in interest rates between theoretically risk-free investments such as US Treasuries or LIBOR and investments that carry some risk of default reflect credit analysis by financial market participation. Before approving a commercial loan, a bank will look at all these factors with the primary emphasis being on the cash flow of the borrower. A typical measurement of repayment ability is the debt service coverage ratio. A credit analyst at a bank will measure the cash generated by a business before interest expense and excluding depreciation and any other non-cash or extraordinary expenses. The debt service coverage ratio divides this cash flow amount by the debt service, both principal and interest payments on loans that will be required to be met. Commercial bankers like to see debt service coverage of at least 120%. In other words, the debt service coverage ratio should be 1:2 or higher to show that an extra cushion exists that the business can afford its debt requirement.
Let us now know about the 5 C's impacting credit analysis. These are character. This shows the willingness of the customer to make the payment. This can be judged from past payment record of the customers. Capacity. This represents the ability of the customer to pay. This can be judged by the amount of capital, financial standing, and past payment records of the customer. Capital. This determines whether the customer has the necessary cash flows to make the payment as and when it is due. Collateral. Sometimes the customer offers certain security to make the payment or generate the cash flows. Such security is known as collateral. Conditions. These are the economic circumstances which might have an effect on the customer's ability to pay. Let us now move on to the second dimension, that is credit terms, which refer to the terms and conditions under which the credit will be extended to the customers. Thus, these emphasize the repayment conditions of the receivables. The 3 main components of credit terms are cash discount. It is an advantage available to the customer to pay the overdue amount early and avail a discount. Thus, the total amount to be paid gets reduced by the discount amount. Cash discount period. It refers to the period till when the cash discount can be availed. Credit period. It refers to the period till which the credit can be extended. The more the average collection period, the more the collection effort involved.
Credit term refers to the stipulations recognized by the firm for making credit sale of goods to its buyers. In other words, credit terms literally means the terms of payment of the receivables. A firm is required to consider various aspects of credit customers, approval of credit period, acceptance of sale discounts, provisions regarding the instruments of security for credit to be accepted are a few considerations which need due care and attention, like the selection of credit customers can be made on the basis of firms' capacity to absorb the bad debt losses during a given period of time. However, a firm may opt for determining the credit terms in accordance with the established practices in the light of its needs. The amount of funds tied up in the receivables is directly related to the limits of credit granted to the customers. These limits should never be ascertained on the basis of the subject's own requirements. They should be based upon the debt paying power of the customers and his ledger record of the orders and payments. There are two important components of credit terms which are detailed below. A. Credit period and B. Cash discount terms.
Example of credit terms seen in a common policy can be like 3 by 10 net 30. This means that 3% cash discount is available for a period of 10 days at the beginning of the credit period of 30 days. If the customer does not want to take advantage of the cash discount, she should pay within 30 days. If she fails to make the payment within 30 days, she will be assumed to be a defaulter. Let us now finally discuss the third dimension, that is collection policy. It lays down the procedures to be followed in order to ensure effective collection of the receivables on the expiry of credit period where receivables become due. The collection effort is one of the important aspects of collection policy. It means the total effort costs that the firm is willing to undertake to recover the credit extended. It will depend on whether the firm offers tight or liberal credit standards. With tight credit standards, the collection efforts can be reduced and vice versa. In deciding upon the collection policies, the firms decide upon the degree of collection efforts and the types of collection efforts. The degree of collection efforts. Tight collection policy reduces the default costs and thus leads to lesser collection efforts. Liberal collection policy, on the other hand, helps in gaining confidence of the customers, increasing the sales volume, but may increase the collection costs and efforts. Types of collection efforts. The firm may undertake various types of collection efforts like letters, reminders, phone calls, personal visits, persuasion through collection agencies, and finally, legal action. Legal action should be the last resort undertaken, as this may impact the relationship with the customers and ultimately the brand image and goodwill of the firm. For computation of effect on the relaxation or extension of credit standards, we can use the following formula, where delta Ri is change in residual income, delta S shows change in sales, 1 minus V is the contribution ratio, Bn new bad debt ratio, K the cost of capital, delta I change in investment. And change in investment can be calculated using the formula as shown here, where V is the variable cost ratio, ACP is the average collection period.
Let us finally discuss how can receivables be controlled. Control of receivables largely depends upon the system of credit control practiced by a business enterprise. It becomes a part of the organization obligations to obtain full and relevant information, complete in all respect, before deciding upon the right customer for the right amount of credit grant. Whenever an order is placed by an applicant, financial position and creditworthiness become essential. Only after ensuring the degree of safety, an order should be accepted and delivered. A firm is expected to prepare sales invoice and credit notes as early as possible. Side by side, it should also ensure that they are dispatched at specified regular intervals for effective control of receivables. It is always considered good to keep a separate ledger for accounts of bad and doubtful debtors. Such segregation not only helps in easy assessment of the position of bad and doubtful debts in relation to the total debtors position. A considerable amount of reduction in debtors can be achieved by offering cash discounts to the customers. Even in case of export sales, segregation of credit sales into separate ledger adds effectiveness to control of receivables. Sometimes large contracts, payables by installments, involve credit for several years. The price fixed in these cases should be sufficiently high not only to cover export credit insurance but also to cover a satisfactory rate of interest on the diminishing balance of debt expected to the outstanding during the credit period. There are two methods of controlling accounts receivables, which are traditional in nature: day-to-day sales outstanding and aging schedule. Though they are popularly used, but they suffer from serious deficiencies. Both these methods are based on aggregation of sales and receivables, due to which the changes in the pattern of payment cannot be easily detected. In order to overcome this drawback or traditional methods, a firm can make use of payments pattern approach.
In this module, we have learned about the meaning of receivables and cost benefit analysis for managing receivables. Further, in this module, we have studied about the various dimensions of receivables management, namely credit policy, credit terms, and collection policy. Credit standards and the types, that is, liberal and tight credit standards, the five C's impacting credit analysis: character, capacity, capital, collateral, and conditions, the different aspects of credit terms: cash discount period, and collection policy. And finally, we have also discussed the credit efforts.
Let us now recapitulate what we have learnt in this module. Receivables generally refer to the debt which the customers owe to the firm from sales of goods or services in the ordinary course of business. Motives of holding cash can be transaction motive, precautionary motive, speculative motive, or compensating motive. There are various costs and benefits associated with receivables management. When the firm is deciding about credit procedures and rules, a proper trade-off between costs and benefits need to be evaluated. The various dimensions affecting the receivables management are credit policy, credit terms, and the collection policies. Credit policies include credit standards, which can be tight or liberal, and credit analysis, which is done on the basis of 5 C's, namely character, capacity, capital, collateral, and conditions. Credit terms determine the cash discount period, and credit period. Examples of credit term can be 2 by 20, net 60. Collection policies help to determine the degree and types of collection efforts which the firms might undertake due to failure of the customer to pay in the stipulated credit period.